Hi folks, I'm Neil McIver of McIver Capital Management at Canaccord Genuity. In this short video, I wish to talk about inflation because it's really a critical factor in your economic future. Now, don't feel badly if you don't feel that you understand inflation, because most people really do not. And that's primarily because it's been almost 40 years since anyone has experienced inflation the way that we're experiencing it right now. Now, I do remember inflation. I remember the devastation it caused. I remember the demonstrations against fuel and food price increases. It destroyed many people's retirement right through the 1970s and all the way into the 1980s. And back then, inflation was in between sort of 6 to 14%. Today, it's about 7% and rising. Now, at its core, inflation represents a failure of government policy and of politicians. In short, it's a mistake. In fact, the whole reason why the U.S. Federal Reserve exists and why most central banks exist, like the Bank of Canada, is to keep inflation at about 2% and to keep unemployment low. These are the only two mandates these vaunted institutions have in our economy. Accordingly, the inflation that we're experiencing right now and that we will be experiencing into the future is a direct result of decisions by the U.S. Federal Reserve, the Bank of Canada, and politicians on both sides of the border to print money and to push that cash into the system, and to do so out of any proportion to the size of the challenge that they faced at the time. In both cases, they have massively grown the size of government as well. At the same time, and to compound the problem, and for purely ideological reasons, politicians in both countries have chosen to artificially restrict energy supply. In doing so, not only have they doubled the cost of filling up your tank when you go to the gas station, but they've greatly increased the cost of delivering goods and services, food, groceries, to you directly. Now, there are other factors that are driving up inflation, such as supply chain failures that you may have been reading about in the newspaper. But money printing, government expansion, and artificially high energy prices are the primary drivers of the inflation that you're experiencing today. The money printing and government expansion creates what's called demand pull inflation, which isn't necessarily a bad thing. The artificially high energy prices and supply chain problems create what's called cost push inflation. Unfortunately, right now, we're experiencing both of those at the same time. Now, it's almost as if nobody in government has ever read a book on economics. Almost. Regardless, the next point to understand is that inflation is an incredibly hard thing to put back in the bottle once it's come out of the bottle. That genie is very difficult, does not want to go back in there. In fact, it took almost a decade, the last time this failure took place, to wrestle inflation back down to a stable 2% range in 1983. In the intervening 9 years, inflation oscillated between about 6%, upwards of 14% annually. And that bankrupted many. It killed economic growth, it killed prosperity, and it damaged the opportunity of those that lived during that period. It was a terrible time economically. Inflation is also catchy. Like a bad cold. It's hard to contain geographically or into one sector or another of the economy. And because of our heavy trade with the US, inflation travels back and forth across the border. It does not respect the border. So whatever happens down there is going to be happening here and vice versa. So like it or not, and we don't like it, inflation is likely to be with us for some time to come. Now, the last point to understand is that this inflationary cycle began in 2020 with a massive set of asset inflation, which means that hard assets such as real estate, infrastructure, gold, art, classic cars, etc., as well as paper assets such as stocks and bonds, all ripped upwards in value. This was predicted by us at McIver Capital Management at the time, and not only did we discuss it with our clients and talk about it publicly 2 years ago, we tactically made decisions to take advantage of that asset inflation when it took place. Stage 2 of this inflationary cycle is the beginning of inflation impacting the nuts and bolts of our economy and everyday living and expenses. And this is what's called economic inflation. But what is economic inflation at its core? And how do you protect yourself from it? Well, inflation is simply rising prices for the goods and the services that you consume on a daily basis, such as food, fuel, and housing. As I mentioned a minute ago, healthy inflation is in the 1 or 2% range. But inflation in the 5% range or 7% range where it is today, or the 10% range, which it may be going to, is not healthy at all. And constant, steeply rising prices creates a whole series of economic pressures and problems for businesses and individuals alike. But the primary problem for most individual investors is that your lifestyle costs more than it did before because your purchasing power is decreasing on a daily basis. So you can think of it this way. If inflation is at 10% and you find a $20 bill that you left in your jacket from last year, it's now worth about $18 because it buys 10% less over the 1 year. Now, pensioners and those living on a fixed income, such as an annuity, for instance, can be put in a terrible spot, particularly if their pensions or their annuities do not adjust for the cost of living, and they don't have very many assets themselves. They simply have no way of overcoming prices that are increasing on a regular basis, and they can afford less and less over time. So unless your income can increase, either through employment or from your assets directly, or your assets themselves can increase in value at the same pace as inflation, then you're quickly sliding backwards economically. And this is the key takeaway for investors and savers, is that if the current 7% inflation rate continues or rises, then your net worth, your wealth, will be worth 7 to 10% less 1 year from now. Unless, of course, you can grow your assets or your income at the same pace of inflation to offset this. Now, this is particularly impactful for many of you who may be living off interest from fixed income securities, such as bank GICs, bonds, or simply holding cash. These types of securities will no longer protect your wealth on a relative basis to inflation. So the first thing that you do not wish to do in an inflationary environment is to own mostly cash, mostly GICs, or mostly bonds. These will guarantee losses on a relative basis into the future for you. The bottom line here is that you need to own assets which will rise with inflation and decrease or eliminate the devastation and devaluation of your wealth that inflation causes on an annual basis. Now, there's several ways of trying to achieve this, including maybe speculating in real estate or using private equity or perhaps even trading cryptocurrencies. But most of these possibilities will force you to concentrate your wealth into just one sector or another. They're too highly positively correlated. And what these problems do is they increase the volatility of your portfolio, decrease your long-term potential rate of return, and of course increase your risk. One opportunity which you should indeed consider is building sophisticated, strong, properly constructed portfolios comprised of well-researched, low-correlated individual positions which will rise with inflation. And if you do that properly, you're going to build a portfolio which has a demonstrated very low level of volatility and risk. And that's exactly what we do at McIver Capital Management. We build and manage institutional caliber, sophisticated portfolios with a long-term track record of growth in all economic conditions that have very little volatility. Thanks for watching, folks. Please click the link below to get access to an exclusive upcoming webinar that I'll be doing on how to protect your wealth in this inflationary environment.